Good morning, everyone. Last class we started with earning per share, and we have learned as of now every US entities must report earning per share on the face of the income statement. They need to report earning per share for income for continuing operation as well as for net income. However, for entities which have complex capital structure, along with common stock, they have convertible preferred stock or convertible debenture, share warrants. In that case, we need to calculate diluted earning per share as well, right? While we learned basic earning per share, we had learned how to calculate profit available for equity shareholder, and we have also learned how to calculate weighted average number of outstanding common stock. While calculating weighted average number of outstanding common stock, we need to note that for bonus share, that is stock dividend, we need to ignore the time. We need to consider it for full year. Same is the case with stock split and reverse stock split. Today we will learn how to calculate diluted earning per share, right? So entities which have complex capital structure means they have common stock, they have convertible preferred stock, they have convertible bonds, and etc. So they must report two earning per share. One is the basic one. This is on the basis of outstanding common stock, and this is outstanding common stock plus potential common stockholders, right? I guess this is absolutely fine. Okay, now let us read. An entity has a complex capital structure when it has securities that can potentially be converted to common stock. So we call it as potential equity shareholder. This is potential equity shareholders or potentially common stockholders, right? So we had to assume that if these potential common stockholders are converted into common stock today, then earning per share will dilute, and we need to show the effect of dilution. Would therefore dilute earning per share. For entities having complex capital structure, right? Both basic and diluted must be presented. Basic ignores potentially dilutive securities in weighted average, and diluted EPS is to give effect of all potential equity share as well. So under potential equity shares, we have convertible securities, we have warrants, we have contracts that may be settled in cash and stock, we have contingent shares, right? Now, how diluted earning per share is calculated? This simple formula: earnings by weighted average number of common stock outstanding, including PES. This is WA common stock outstanding, including potential common stock. Right? This was numerator for BEPS, if I am not wrong. This is numerator for BEPS. Now, from this earnings, in case of BEPS, we already know that interest on debenture is subtracted, preferred dividend is also subtracted. Now, once these preferred stockholders will be converted into common stock, then in that case you won't be paying interest anymore. If you had convertible bonds, You won't be paying preferred stock dividend if you had convertible preferred stock, right? So there will be a savings. There will be a savings, that is earnings for common stockholders will increase if convertible preferred stock or convertible bond or warrants is converted to common stock, right? As of now, while calculating basic, we only consider the one which is actually outstanding. But when we calculate dilutive, so you need to consider the potential common stock. So we need to assume that these convertible preferred stock, these convertible bonds will be converted to common stock. If these are converted to common stock, in that case, you won't be paying interest anymore. You won't be paying preference dividend, right? So these will be your savings. As a result, your earnings will increase. Same is the case with weighted average number of common stock outstanding, right? This is D for BEPS, denominator for BEPS. If convertible preferred stock or convertible bond or warrants or etc. are converted to common stock, then WACSO increases, but the overall earning per share will dilute. This is what diluted EPS is all about. The rate at which the numerator is increasing, the rate at which denominator is increasing. Denominator is increasing at a much more rate than the numerator. As a result, your earning per share will dilute. Right? So we'll be looking after all the potential common stock one after the another, right? So first let us go for preferred stock dividend. Convertible preferred stock. So this is one of the potential equity share. This is potential common stock. This is not common stock as of now, but in future it will be converted into common stock, right? So when you calculate diluted, you need to note one thing. While calculating diluted earning per share, we need to assume if converted. This is main, right? Adjust the numerator because savings earnings will increase. Increase the denominator, number of common stock that would be issued to potential equity shares. There might be a case upon this conversion, your earnings will increase. Means numerator is increasing at a much faster rate than denominator, right? So in that case, we won't report this as diluted earning per share, right? Only we will report diluted earning per share when it is depleting, when it is reducing, right? Okay. So there's a simple example. We will do this, right? Carlin company has outstanding 1 lakh shares of common stock. This is already outstanding. So this will be considered for BEPS, right? And 10,000 shares of convertible preferred stock, convertible into 5 shares of common stock, okay, for each share of preferred. Net income for the year is $1 lakh. Dividend declared during the year was 20,000 on the preferred and 30,000 on the common. Compute the diluted earning per share assuming a 34% tax rate. Now listen to me very carefully. When they have given net income, means this is already after tax. The word net income means net income from continuing operation, means this is already after deducting this 34% tax, right? So from this we are only going to subtract preferred dividend, not the equity dividend, not the common stock dividend, because we need to calculate earnings for common stockholder, not retained earning for common stockholder. There is a difference between earning for common stockholder and retained earning. So after paying preference dividend, whatever is left, that is earning for common stockholder. From that earning, when you pay off dividend to common stockholder, then that the remaining part is retained earning for common stockholder. So we are not concerned here with retained earning. So whatever dividend you have given on the common stock, that needs to be ignored. It is not relevant for our discussion. Okay. So let us do this. It's very simple. Example on convertible preferred stock. So first we will calculate basic earning per share, that is earnings for common stockholder divided by weighted average common stock outstanding. So $1 lakh is the net income. From this I'll pay preferred stock dividend and weighted average is 1 lakh. So we are getting 80,000 numerator divided by 1 lakh shares. So it is 0.80 per share. Simple. Nothing much to understand here. Right. Now when we talk about diluted, so already we will take the numerator for, this is the numerator for basic earning per share. This I am going to take plus savings. So if this convertible preferred stock is converted to common stock, then I am not supposed to pay this dividend. This is savings. If convertible preferred stock converted to common stock, denominator is already 1 lakh share plus, this is denominator, So we have 10,000 preferred stock. It will be converted to 50,000 common stock. Each is converted into 5. So 10,000 will be converted into 50,000. So my numerator will increase by 50,000 shares into 12 by 12 because they are not playing with the time. So as a result, what is happening? Your numerator is 1 lakh. Now you can see that from 80 it became 1 lakh. Means roughly around 25% increase numerator. But denominator is 1 lakh say 150. So it is increased by 50%. So when this rate of increase in numerator is lower than the rate of decrease in denominator, then in that case you get the diluted earning per share. If you clearly see from here to here, it is increasing by 25%, and from here to here it is increasing by 50%. So when this rate of increase of numerator is lower than the rate of increase of denominator, then in that case you get this diluted earning per share. Otherwise it is anti-dilutive, right? So as a result we are getting 0.67 per share. So earning per share has diluted. So this is the basic earning per share, and this one is diluted earning per share. Okay, let us move ahead. Net income, another example. 9% preferred stock. So we have 5 preferred stocks. So the dollar value is 500. That will be converted into 50 common stock in future, not now. So this is potential common stock or potential equity share, whatever you say. And already we have 100 common stock. So if I have to calculate basic earning per share, that is earnings divided by weighted average common stock outstanding. So weighted average already outstanding is 100 shares. This is already outstanding. Dollar value 500 into 9% preferred dividend. Very simple. Now, when I talk about diluted earning per share, it's very simple. Already whatever earnings I have, I will take that, plus I will take savings, because if converted I won't be able to be I won't be paying any more this preferred dividend. So my earnings will increase for common stockholder. Already 100 it's outstanding, plus 50 it will be converted. So we have $800 divided by 150 shares. So 800 divided by 150, that comes to $5.33 per share. Very simple. So first you calculate basic earning per share. So you got the numerator and the denominator. If converted, if potential common stock is converted to common stock today, then there will be a savings in numerator. The denominator will also increase, but the rate of increase in numerator is lower than the rate of increase in denominator. As a result, your earning per share is depleting. Basically, you want to show the effect of these dilution which is going to take place in future. Right now today I am showing the effect of these dilution, these dilutive effects today, right? Income statement, we know from the net income we pay preferred dividend, we get earning for common stockholder divided by already outstanding. This is not already outstanding. This 5 shares, when it will be converted, it will be converted into 10 common stock each. So 5 into 10, 50. This is potential. So only for diluted EPS it will be considered, right? So this is basic and this is diluted. Now simply we'll do it for convertible bonds same way, right? We have already done it in case of convertible preferred stock. In the same way we will do again out here. If converted, we won't be able we won't be paying any more the interest, so that is the saving, but we need to consider it net of tax. As preferred dividend, we pay as preferred dividend is paid after we pay income tax. So when there's a savings of preferred dividend, there is no tax savings, because anyway after paying tax you are allocating it, right? But when you are not paying interest, so in that case your tax liability will increase. If this is not an expense, you will report more net income, so as a result your tax liability will increase. So therefore you need to consider net savings. Interest is savings, but tax outflow will increase. So we would need to do I into 1 minus T. This is your net savings. Because anyway, if you are not paying interest, your tax expense will increase. So you need to consider net of tax. And same denominator we are going to add with the number of shares that we have been issued with the if converted, right? If it is anti-dilutive, we are not going to report it. Only diluted EPS will be reported if it is decreasing, not to be reported. Right? Let us see one example. Now this is net income. Already interest and tax is subtracted, right? $5 lakh each bond is for 1,000. So number of bonds 500 bonds, and if converted, each is going to be converted into 10 shares. If converted, it will be into 5,000 common stock. Okay. So this is convertible bond. Earnings for common stockholders, weighted average common stock outstanding. Now we don't have any preferred dividend out here. So whatever is your net income, that is fully for common stockholder. That is 1 lakh divided by 1 lakh shares. So it is $1 per share. Let us now see diluted earning per share. Right now, already we had $1 lakh and 1 lakh shares if converted. So there will be interest savings. So how much is interest? $5 lakh is the bond par value. So bond value into 6%, 30,000. But we need to take net of tax. Tax is 34%, so 0.34. As a result, these 500 bonds will be converted into 500 common stock. So this is $1 lakh plus this is $19,800, and this is 1 lakh share plus 5,000 shares. Now here you can easily see it is increasing by approx 20%. So it is increasing by 5%. So as a result, it is anti-dilutive, so would not be reported. If you see, your earning per share will come to, diluted earning per share will come to 119800 divided by 1 lakh 5,000 share. So this is anti-dilutive. would not be reported. See, existing shareholder is never concerned with the earning per share increasing. Every investor will be concerned more about the earning per share reducing. That is why every US entities must follow certain rules and regulations, right? You must be knowing that whenever we are redeeming debenture holders, so or sorry, whenever you are buying back equity shares, whenever you're doing stock retirement or any kind of repurchase, or you are paying preferred stockholders, so in that case, in order to maintain creditors protection, there are some restrictions on the dividend that we are going to distribute to the shareholders, right? So if the earnings are increasing, no problem, no need to report that specifically. But if it is depleting, it is reducing due to this conversion, if converted, because anyway this conversion is not actually taking place today, but it will take place in future. So you need to show those future figures today, so that investor is aware of the circumstances, that okay, fine, yeah, I know the company, in order to raise funds, the company has issued some kind of potential common stock, which is not common stock today, but it will be common stock tomorrow. So our earnings are going to deplete, right, as a result of that. So their sort of awareness is already given, information is being shared, right? So if it is anti-dilutive, you will not be reporting. That is what they have written here. It's clearly explained. So it is 1.14, whereas basic is 1. So anti-dilutive would be excluded. This is very important. This is a bit tricky one. Net income is 800. Interest and taxes paid. Now you have preferred stock. Dollar value 500. Cumulative. Even if not declared, it will be subtracted. First, I am worried about the basic earning per share. So for basic earning per share, we are only going to see the issued one, right? So we have another example. $500 into 9%. Even if they haven't declared it, still we are going to subtract, because it's cumulative. We already know the rules. For calculating basic earning per share, it doesn't matter whether it is convertible, non-convertible, right? Preferred dividend will be considered. This is earnings 755. Okay. Already we had earnings, right? Now preferred stock is not convertible, right? So we are not going to consider it for diluted earning per share. Only convertible bonds will be considered. Had it been convertible preferred stock, then we would have shown two savings and denominator will increase by two amounts. But preferred stock is not convertible. So it won't be considered for the purpose of diluted earning per share. So if converted does not apply here. If converted does not apply. Out here, 3 bonds each into 25, 75 common stock. Right? There's a savings of interest. 3000 is the bond value, 7%. And then net of tax. So 3000 into 7% is 210, 1 minus 0.3. So this is So this is dilutive, no problem. Okay. So if it is anti-dilutive, you are not going to consider it. Even if it is only if it is dilutive, then only in that case you are going to consider. So this is the increase in numerator and this is the increase in denominator. But the rate of increase in numerator is lower than the rate of increase in denominator. Then only it is dilutive, right? Okay. So this is 7.55. Right. Now we are going to consider another potential common stock. This is also potential common stock. Now, one thing you need to note that this is always dilutive because numerator doesn't increases because share warrants are such type of instrument wherein you tell that you apply for the shares and and allot you shares in future, right? So these are warrants and as a result currently you are not paying them anything, right? So if I'm not paying them anything, so when I convert them into common stock, there won't be any savings also, right? So generally numerator doesn't increase by any amount. However, when you issue common stock, the denominator will increase. So this is always dilutive in nature, right? So we apply here by using the uh, Treasury Stock Method. I'll explain you with the help of an example, right? So basically the idea is ki, whatever proceeds you are getting, right? Whatever proceeds you are getting by issuing warrants and options of these type, so you will be using that money to buy shares from the market. So maybe you have collected 25 rupees and the market price is around about say 30 rupees. So with the proceeds you will be buying less number of shares, right? So out here the proceeds from the exercise of this will be used by the company to repurchase at the prevailing market price, resulting in an incremental increase, right? Now this is very simple. Suppose I have paid money for 100 shares. Suppose I have paid money for 150 shares, right? And 20 rupees is the exercise price. So what is the proceeds collected by the company, right? Proceeds from warrants, right? Whatever. So this is the proceeds I have got. Now this money, suppose this money is used by the company. This money is used by the company to buy shares from the market, right, at the prevailing market price. Suppose the market price is 30 rupees. So with this I will be able to repurchase only 100 common stock. So 150 shares, for 150 shares they have collected money from investor, and with this money they will be only able to buy only 100 common stock, right? So they have given money for 150 and I'm only able to repay. So as a result, the shares, the incremental number of shares are increasing, right? This is how you show the treatment, right? So I'll show you one example, and with the help of that, we will be able to understand it, right? Now, this is generally not the case if the exercise price is more than the market price. So you never going to buy from the company. You will directly go into the stock market and buy. So if this is the case, then it is out of money and it becomes already anti-dilutive, right? So you need to note these things very carefully. So this is how we are going to do it, right? So number one is the market price is greater than the exercise price, then only it is in the money and you are going to exercise that, right? Whatever proceeds you have collected from these share warrants, right? We are going to repurchase common stock at the market price. It has to be in the money. So this results in dilution. So the difference will be the incremental increase. Right? So this is how, this is another on the basis of formula. This is the uh, formula by which they have done it, but we are going to do it orally, so it becomes easier for us, right? This is basically proceeds from warrants, right? And this entire part will give you number of common stock repurchased, and this whole part, this is incremental number of common stock, right? So this is very simple. So you have given 1000 option to purchase 1000 common stock, right, to the investors, and they are ready to subscribe for 15 rupees is exercise price, whereas the average market price is, year end market price is not relevant because they have used the word average market price. So what is the proceeds from this option? Proceeds collected from stock options that is 1000 into 15. Number of shares that would be repurchased. So this is 750. Right? See, formula approach also you can go, but this is not required actually. So first let me do basic earning per share, right? This is another example. See, one thing you need to remember, you need to practice, practice and practice. The practice gives you a lot of confidence when you go and appear for your exam, right? It's a 4-hour exam. You need to be cool, calm, composed when you sit for exam, right? And the only thing you need to note is practice, practice and practice. The more you practice, always give a practical approach to every problem, right? Just remember the concepts and just apply those concepts and answer will come automatically, right? So X reported net income. So this is my net income, right? For basic, preferred stock dividend will be subtracted and it is cumulative. So even if it's not declared, we are going to subtract, right? And this part is potential common stock, right? Let's not discuss right now. So we'll first calculate basic earning per share. So basic earning per share is equals to 800 minus preferred dividend 45 divided by 100 shares, that comes to 7.55 per share. Is it okay? Now, first of all, we have to calculate incremental number of share. So 60 options has been given to purchase at 25. Sorry, each stock option gives them 600 common stock. Okay, fine, no problem. So X also has 60 outstanding stock option which entitles the holder of the option to purchase 600 common stocks at 25 per share. So let us do one thing. So there is some printing mistake. It will be 60, not 600. Wait. See, each shareholder can get 1 share as option. Each shareholder can get 10 share as option, but this figure will be very high. So that is why. So every stock option entitles the holder to purchase 1 share, right? So let us do. Proceeds from stock option is 60 into dollar value 25. That comes to 1500. Number of shares, that would be repurchased. So I have to use this proceeds. So that comes to 50 shares. We can do this by formula also. Now when you calculate diluted earning per share, already we have 755. If these are issued now, it is 0, because anyway when I have given them this stock option, I was not paying them anything, right? So when I convert them into equity, so there won't be any savings, but it was 100 shares, so it will increase by 10. So this is 755 by 110. 6.86 per share. So again, it's dilutive in nature. It can be employee stock option, it can be normal share warrants, anything. So again, these are some other examples of potential. This is always dilutive. Right? These are some dilution effect from contingent shares. We are not taking any cash consideration out here. There is no such cash consideration. It simply depends upon some future event or certain conditions being met. And if the conditions are being met, so it will be considered in basic earning per share as well, because in that case it will be issued. Right, you can just give a self reading, very simple. Now cash flow per share won't be reported, this I have already told you. And these are some additional disclosure requirements. Right, this is a summary. Of how diluted and basic earning per share is calculated. Right, that's it. So you practice MCQs and sim based on this particular topic. So next class we'll be taking up some different topic. Thank you so much.